Hi everybody, this is Gary Dean, and this is our nightly video report for Thursday, March 17th, 2016. So the party continues. It was kind of a similar kind of reaction that we got after this ECB, where we saw the indexes drop, and then from there the next day is when they had the big ramp up. And yesterday was, even though the markets were up, they came off their off their highs, and then today they kind of took everything out. But it's until price breaks, I can give you all the reasons in the world on why it's that it's still not safe. And it's I don't mean to be beating a dead horse or just sticking to a position, but when you start getting, these are the breadth charts again, and when you start getting things at these levels, you really don't. This is what gets everybody really, really bullish on the markets, and everybody jumps in, and everybody's bearish on the markets when we're down here. And we're at these levels right here, and if you notice where price is, we're nowhere near where the previous tops were. So it's something you just want to keep in mind. I mean, I would love to say that price is going to break tomorrow, just because I do believe that when it does fall, it's going to go down a lot faster than some people think. But anyway, this, again, is just saying that things are very, very overextended. You look at the put-call ratio here, and it's well off the bottoms, and usually, when you see people starting to buy puts now, after hitting an extreme low level like we did, some kind of drop is usually pending. So somebody's positioning themselves for some kind of setback with the options end of things. And then just looking even at the bullish percentage thing, we're at levels that, unless we get into this, dragged out bull market like this, which I don't believe we're in, I still believe we're in a bear market. And until the bulls can push it through these highs, it's going to be considered a bear market until then, because it's just the way, just regular technical analysis. So if you notice, we're at levels right now, and it has a very similar pattern to it as we had here. And from there, we had a 100-point drop, rallied, and then from there, we know what took place after that. And, we're here right now. So again, even though, I can sit there and say I'm expecting the pullback until price actually does drop, the bulls are in control, but it doesn't mean that it's safe to just be, jumping on the long side. So if we take a look at our irregular charts, let's take a look at the Dow. I mean, this is just a massive, massive rising wedge right here. I'm kind of surprised we're not into the extreme overbought levels, just because from it. I'll show you on the S&P, because we actually already here. But the thing is that we're still within this this bearish rising wedge right here, and but the thing is that we close this gap, and if they're going to push higher, you have this resistance at the 17,727. So can they push another 200 points higher? Maybe it's it's just another day like today, but it's only going to extend the divergences that are on the 60-minute charts. So if we look at the S&P, the part that I'm kind of kicking myself is that when we were down here, I was, saying that this, that we could see the S&P make a run up to the 2043 to close this gap. And once we got here, and as far as time-wise, and we had the pullback, this is what kind of shook me out, because as far as the time period, this is where I was expecting at least some kind of pullback before heading up, and instead they gave us a head fake and then went straight up, and then we started hitting resistance zones, and they gapped it above those, but we closed the gap. So yeah, I'm not happy, because this was my original target. But one other thing I want to show you is price and time, and this is from this low here going back to 928, and the top came on 11.2, And then from there, we started to chop zone before we went down. Well, if you look at the price and the time on it, we're actually almost identical to it. It could make a run to the 2055 level, which, not that far above, and we almost hit it. We were at the 2046. But in any case, you can see it's a very, very similar type move right here. And plus, we have this resistance as well as bearish divergences, and we are at overbought levels on the SMI. So again, even though it would make sense if we head down from here until price breaks, the bulls are in control, and I think really the first thing they're going to have to do is get it through to 2017 and then to 2007. If that happens, most likely, if you look at the moving average heading down, we're going to come back down and test this. And this is what was happening here when we had this extended move, because I remember, I got caught on this one too. And, I said that, this moving average coming down, even if we're going to start a new bull market run up, they're going to come down and test it, and that's pretty much exactly what they did before breaking below it. So this is still heading down, and it's at the 1931, and I've been saying I'm expecting at least a 100-point drop, so that would bring us into this area here. But in any case, just the pattern-wise is, again, just saying be careful. As much as I've been wrong on expecting the pullback right now, when this, we're still in the bear market end of things, and when it does run its course, usually these drops happen very, very fast. So that's why I'm kind of just trying not to watch it. And like I said, if they start taking out levels, you got to call a spade, and that the lows may be in, but I just don't see that happening right at this particular point. So on a 60-minute chart, bearish divergences continue to exaggerate here. The bearish wedge, you always give a little bit of an overthrow, and we did close the gap. So again, what the bulls bearish have to do, push it through this 2011. If they do that, then the next really confirmation would be right around that 2008. So these are the two areas that the bears need to push through. If they do, then we'll see a quick drop down to the next support level, and then from there it's a decision that the bulls are going to have to make, whether they want to keep things up. But just this pattern wise, you would be expecting a move to come someplace down into these levels, which is really the base of the wedge right now. But you have to see price break before that's really going to kick into gear. 15-minute chart, again, the bearish divergences, just a 23% retracement brings us to the 1991, but that would do all the damage as far as with the the support levels as well as the wedge. So if they just do a 23% retracement, it's going to have technical damage to things. And not only that, there's still a plethora of open gaps below that have not been filled, and the last one is all the way down at this 1865. So as I was saying that this gap was going to get filled, I can almost assure you this gap is going to get filled too at some point, and it may not come in that so far distant future. So with that, let's see what plays out tomorrow, and have a great day.